What's up, Gould Miners? In today's episode, I have the privilege of welcoming Daniel Lichtman, a multifamily investor that has over $150 million worth of assets under management. In this episode, we start with Daniel's early years as an acquisitions manager for a group that specialized in distressed property acquisitions. We also talk about the current distressed sellers and distressed assets in today's market and how investors like yourself could take advantage of the current environment. Later on, we explore the advantages of multifamily investing versus single-family investing, and then we wrap things up by delving deep into the interest rate environment right now and what investors like yourself can do to navigate the current environment. Lots of great insights on this one, so without further ado, everyone, let's welcome to the show Daniel Lichtman. Daniel, welcome to the Gould Mine.
All right, thanks for having me on, Danny.
Yeah, well, I've been listening to some of your stuff, and I know that you've made other podcast appearances, and let's just start at the genesis of it all, Daniel, because everyone has that aha moment when they decide to get into real estate, right? So, what was that aha moment for you to switch or to pivot and to dive into the world of real estate investing?
So that's a great question. So I actually started off initially. I wasn't sure exactly where I wanted to go. I started off in an operations manager role and the head of a sales for a fleet maintenance company here in New Jersey, where I live. I used to go to a study lecture every night with somebody else that ended up becoming my boss the next 4.5 years that was in real estate. And I used to be, enthusiastic. I'm very passionate about what I do in general. And I used to tell him about my sales work and how I'm working at the companies, trying to bring them in. And he felt that my people first and my persistence would be great for acquisitions. He told me, I want to hire you to be my director of acquisitions. At that point, I didn't know what acquisitions meant. I didn't know what that were. I tried Googling it. I tried seeing what that meant. And obviously that didn't really come out with much because of a lot of different versions of acquisitions. I started working for him at the end of 2015. He was more distressed debt junkie. He liked buying anything that was distressed. So he bought defaulted notes, REOs, tax liens, things of that nature. So I managed his fund, reaching out to different lenders, servicers, attorneys, et cetera, you name it, try to find these more distressed, quote unquote, distressed assets, which were tough to find in that market. It was already kind of, after things already had started cooling off.
Yeah.
So that was my experience, how I got into real estate. I was kind of thrown into it. It was more on the single family and smaller commercial, small multifamily and smaller commercial space. But I was very hands-on from from anywhere from reaching out to banks or going to conferences all the way down to being on the property level twice a week, being there from a management, asset management perspective. So it wasn't just, cold calling or behind the scenes or a desk job. It was very much hands-on. And I really got to learn everything from the top to the bottom. And that was my first experience in real estate. I was there for about 4.5 years. I realized that there's more to real estate than just the single family and the smaller, mixed use commercial properties. I started getting very active on LinkedIn, and I noticed a lot of people that were starting to broadcast what they were doing at that point. It was 2018, 2019. People were starting to get into, there was a lot of syndicators that were coming out, discussing what they were doing on their multifamily properties, and it got me very interested to learn more about how it works on a larger basis instead of, focusing on a smaller single family portfolio or a smaller 10, 15, 20 unit. People were doing it as a 50 unit, 100 unit, 200 units. And it very much intrigued me. Sure. And that was kind of my aha moment once I was already in real estate, kind of transition from the single family to multifamily space.
Yeah, that's interesting. And I definitely want to go more in depth into that. But before we do that, something that just crossed my mind as you were talking about your original acquisitions role, looking for distressed assets. Now is the time to do that. For the next 12 to ish months or so, right? Who knows what the Fed's going to do? Who knows what the rates are going to look like? There's some talk that maybe things are going to ease up sooner rather than later. But if that isn't the case, or, regardless, there's going to be some blood on the streets. And so what are some of the things that you learned in that early role that listeners could deploy to go out there and find distressed assets of their own?
So I think it's very important to have the right context.
Yeah.
In my role, it was kind of the post 2008. A lot of the lenders had taken back a lot of properties that they thought they'd do a better job than the sponsor. I think now it's going to be, you're going to see less of that. I don't think you can have as many REO foreclosed type of properties. I think lenders either want to work it out or want to try to solve the debt or try to negotiate or have somebody else kind of step in. So I think there's going to be less of bank-owned properties, although you're definitely seeing some of them come to market now.
Yeah.
I think something that I actually learned recently is that my company that I'm at now, even though we don't focus on distress, we're more in the value-add multifamily space. We actually purchased a property that was about 30 to 40% occupied. So it was definitely a distressed type of asset. Some of the things that we learned was that the costs of purchasing such a property are actually higher in the sense your insurance costs, your and carrying costs, obviously, certain things that, maybe we underwrote a little bit lower, and then we had to kind of fine tune it once we saw that, hey, the property is only, less than 85% occupancy. You have to deal with, besides higher cost of capital, higher cost of insurance. So just it's a good thing to keep in mind if someone is chasing these distressed assets, to make sure they're well capitalized, to have the fund that they need to turn around the asset, and also to be well capitalized in terms of insurance and other costs that are, obviously going to be a lot higher being that it's more of a distressed asset.
Yeah. And I think that there's a big difference too, and it's worth noting that there's a difference between distressed asset and distressed seller, because right now I am seeing a lot, and I focus more on hotels, not multifamily, but I'm seeing a lot of really like awesome hotels whose sellers are in distress, and right, so there's a big difference. There is a difference there. So are you? Because I'm really curious, right? Like, because you focus a lot on multifamily, and I don't, explore too much in that space. I know enough to be dangerous, but like not that much more. So what are you seeing more of? Are you seeing more distressed assets or more distressed sellers?
I would say a mix of both, but yeah, definitely you're right. You hit it on the nail on the head. It's definitely a lot of distressed sellers. Mm-hmm. You're right. The properties don't have to be, 30, 40% occupied in order to be distressed in today's market. Distress could be just, underwater in the sense of not being able to make certain payments and, maybe rate caps expiring or certain things of that nature. So I think you're definitely going to see a lot of that. But I do feel that the lenders are trying to work with those sponsors more than they were in 2008, 2009. So as much as there's going to be people that have a need to sell, I feel like the lenders are going to have to work with those borrowers to work things out or to let them bring in new prep equity or fresh equity to the table. Because a lot of those deals, yes, there's some deals that, that people overpaid in maybe 2021, in more recent years, but there's a lot of deals that are just, nobody would have predicted rates where they came to today, and with a little bit of extra equity to get them. Like I heard something survive till 25. We're hoping not that long, but that's what people are kind of, hoping for. So people that are kind of running out of time, but could put in some fresh equity for another 12 to 18 months just to run, to get past that. I think that's going to take away from the surge and surge of distressed assets. But yeah, it's definitely to your point. There will be distressed opportunities that may not be physically distressed, but just financially distressed for sure. Yeah.
And here you kind of talk that through. Something that came to mind as well is like, you're right. I do suspect that, and this is something that, a lot of my friends and people in the industry we've all been kind of talking about and everything, is that, yeah, the banks are going to be more inclined to work it out with the seller, but then also like if I'm looking for opportunities, it sounds like maybe a better approach instead of approaching the seller would be just to go directly to the bank and see if you can start talking to them. Like, would you agree, or is that not something that you would recommend?
No, definitely that definitely is a selling point. As opposed to going to the seller, especially if they're really underwater, go to the lender and say, hey, if you're going to take back this asset, it's not going to be worth your time to run and manage such an asset. I could take it off your plate. And, maybe you were going to lose X amount of $1 million. I'll give you instead of a $3 million loss, I'll come in and maybe $1.5 million, kind of split the difference and recapitalize and take it on. Yeah, definitely. I think both approaches have their own merits. I think it really depends on the situation. Certain times it makes sense to approach the current, borrower and say, hey, we'll step in, we'll assume the loan or do something that we can put in fresh equity. And sometimes where the guy's so underwater, and you have especially if you have a good relationship. It really goes back to the relationship. If you have a good relationship with those lenders, where you're in touch with them on a constant basis to see how their portfolio is doing and how you could release some of their stress, then you could definitely, there's definitely could be opportunity. But I think if you're kind of swoop in and say, hey, there's opportunity now in the stress, let me call this lender and see if I could do something, unlikely that you're going to be able to move the needle much when he has, I'm sure plenty of other people that have been chasing him and reaching out for the same type of deals and opportunities. So it really does go back to relationships. I think that's crucial.
Yeah, fair enough. That makes a lot of sense. So switching gears now and going more into the, where you were at before single family sector and then switching into multifamily. So I think that there's a myriad of different people who listen to this video, like types of investors. There's the ones that are just getting started. There's the ones that are kind of in that bit in between phase. And so you were in that in between phase when you switched from single family to multifamily. What were some of the advantages that you saw to buying a 200 unit, right? What were some of the advantages that you saw? And also, what were some of the challenges that you experienced in multifamily that you never experienced in single family?
Sure. So that's a great question. So I'll give you an example of why I thought that it made more sense to go for a larger property than just a single family. At the company that I was managing this portfolio of single family, we had one property that was a single family rental in Trenton, New Jersey, that was down for over a year because of an issue with the gas line. It took numerous times to bring out a plumber from North Jersey to come to Trenton, which is about an hour or so away. I got the best guy to come out there, figure out what's happening. The city wanted, or the gas department, just giving this context, the gas company wanted to charge us a few $1,000s just to fix the line, even though it didn't make any sense. We finally got this plumber to convince the gas company that it was their mistake, and they were able to fix the line. The line was crimped, and they were able to fix it. My point of the story is that it took us over a year to be able to get this turned around, to be able to rent out the house for $800-900. So that was just a one house that has its own, mortgage or whatever it is, that was sitting there vacant, versus if you have a 200 unit property and you have a few vacancies, yes, it's ideal. Of course, it's ideal to have it as, full as possible, but if you have that one or two or the several vacancies, that's not going to make or break it or kill the deal. So that for me was kind of my aha moment in the sense of why I wanted to shift from the single family to multifamily. In terms of the surprises and things that I never really focused on, I think, with single family, it's pretty, straightforward. If you buy for X amount, you put in X amount, you're going to get this amount of rent. It's pretty straightforward what you need to do. With multifamily, one of the first properties that I was, in my company that I was working for previously, it was a 414 unit deal in St. Louis. It was an off-market deal. My role was in acquisitions and asset management for that property. And it was really hard to gauge how much money that the deal really needed. The property was, was only 65% occupied. We were getting it at $21,000 a door. It's back in 2021. So pretty good, pretty low basis. However, it needed a ton of Capex, and it was very hard to really assess it. So I kind of learned through the years of, underwriting and going, and seeing deals and going through deals to be, it's super crucial and key to really know how much Capex is really needed in order for the deal to make sense. Because if you're buying a deal at a low basis and it seems like a great deal, but you're going to have to put, half as much or as much as the property's worth in the Capex, and then you're in it for a lot more than what you initially anticipated, that it may not be as good of a deal as what you anticipated. So that was something that was definitely something new for me when I was getting to the multifamily space, was really understanding the Capex and the needs of the property. That was definitely a new thing for me.
Yeah, definitely. And going back to the vacancy thing, I mean, that's something that, so many people talk about, right? When you're looking at the advantages of going multifamily, it's that, one vacancy doesn't kill you, right? Versus single family. So that's, it's a point well taken. And let's say, so if you are, say, an investor who is looking at putting like you're faced with two different options right now. You've got, let's just say $100,000, right? Let's just $100,000. Is it better to invest in a single family property with that $100,000, or is it better to go in as, say, like an LP in a syndication deal where you can be a smaller percentage owner of a larger pie?
So it really depends on what you're looking to do. It's interesting you say that because I have a friend of mine that over the past weekend who's invested passively in multifamily properties, and he told me, for now, I'm buying smaller single family, these $300,000 homes locally. Literally your question.
Yeah.
And I'll take 30-year debt on it. I'll refinance when it makes sense. I'll fix it up. And he said, I have a management company that's going to manage for me. I like that. I prefer that better. But most people that are busy and they're 9 to 5 and they're busy in their W-2 are not going to have the time to be running after, plumbing and boilers and leaks and roof issues and other things that comes into play when you're managing yourself, a single family. Plus with single family, like I mentioned before, when somebody moves out, there's always that, pressure to turn it around and to rent it out as soon as possible. So although, there's, merits to both things, I would say, it's still, it really depends on your scenario and situation. If you have the time to focus on single family and you want to do that, I understand that, but you do typically hear on most podcasts where people say, oh, I made a mistake starting in single family and now I got to multifamily. So,
yeah,
I think ideally would be to do multifamily in an active role versus a passive role if you can. But if you have $100,000 to invest, like your question, I would say, definitely still look at the multifamily opportunities out there.
Yeah, it's interesting because, I think that, well, especially in like the last 10 years or so, right, that the internet has brought a lot of access to people, like just in terms of like investing philosophies. And you didn't, all that was available before is like Rich Dad Poor Dad, right? Like that was it, right? But since, the YouTube and everything has really started to ramp up, and you get things like Bigger Pockets that have shown up and all of these different investing forums and sites and YouTube channels, the ability for investors or the ability for people to like come in and kind of get this almost this like false idea of like what it really means to be a real estate investor. Can you explain, when you were in doing single family, like what was the level of like, what was the time commitment like and everything? Because a lot of us, we see the forum on Bigger Pockets. We're like, oh, I could totally do that. Right. But then you get into it and you're like, oh my gosh, like that is so much more. I bit off way more than I could chew kind of thing. So what was that experience like when you were first kind of like getting into that, and what was your reality versus your expectations going into that?
Yeah, so I didn't have a ton of expectations, but we did have an on-site manager that handled a lot of the day-to-day things. But there was a point for about 6 to 8 weeks where I was the on-site manager, and I was down at the properties 12 hours a day, running around trying to get these, vacancies filled, dealing with code enforcement issues, dealing with busted pipes, dealing with toilets down. So it definitely is more than just, hey, a side gig. I'll go on a Sunday once a month and I'll make my tenants happy and bring them, coffee and donuts. It definitely does take a lot more. However, there is times that you could, build out a portfolio and start, bringing in the right staff and have somebody help you manage it and make it more manageable. But it definitely does, it does take a lot. And I don't think I would recommend it to somebody just to kind of do it on the side. I think it's better to have like a full-time focus on it if you're going to do it, and go all in if you can, on whether it's single family, multifamily, or whatever real estate, you're targeting.
Yeah, I would definitely agree. I think that a lot of, having been on the residential side for so many years, and a lot of the clients that I helped buy investment properties, or for example, like a very common one was they would hold on to their exiting property, right? They hold on to it and then they'd buy another one and then keep the exiting property as a rental. And more often than not, I would get a phone call like less than 2 years later and be like, hey, you need to help me sell this thing. Before the tax exemption is gone, I need to sell this because I just can't do it anymore. I think, and obviously, like as you start to scale, like you're right, you could start to, bring in more of like an infrastructure and like a support staff and everything. So it's like that messy middle where you're like, under a certain amount of units. And I think that number is different for everyone or any person. It's just based on your own capacity levels. But it's interesting that you feel the same way, or that you're thinking in the same way. Cause I've always thought that too, is like, if you're not ready to go all in, it's probably better to find more passive investment opportunities that they'll yield almost very similar results and way less headaches.
Right.
So let's switch gears right now to your acquisitions and asset management experience. When you're looking at multifamily deals right now, what are the key things that you're looking for on the acquisition side to determine whether or not like this is a deal that you want to pursue?
Sure. So in today's market, the first thing we look at is, positive cash flow. We're not looking for any deals that are negative leverage. And right now the rates where they are, in order for a deal to make sense, we're looking for something that's, north of whatever, in cap rate has to be. In today's market, it's probably north of the 6.5 cap, which a lot of brokers don't want to hear.
Sure.
And we typically like to build it out about 2 to 2.5 basis points. So we're going to go, build it out to like an 8.5 or even close to a 9 cap over a 5-year period. And what that means is that we're going to look for a property that has already cash flow currently, but it has upsides. We can go in and do some strategic renovation. So we're not looking to do a major turnaround or to complete, revamp of the property. We do look for something that has that we can do strategic renovations to it and provide, a certain niche of a value add to it and really push the rents based on our comps. So we definitely research and look at a lot of comps to make sure that the property does have that upside. Typically, if a property is already, a newer property already been, kind of renovated and at top of the market, it's usually not going to work. It's not going to be enough of a cushion, enough of a value add. But we typically look for something that's in place cash flow that has upside as well.
Totally hear that. And I'm also curious because another trend that I'm observing right now in hotels, and I'm wondering what you're seeing right now in multifamily, is yes, pushing top line is super important, but we're also seeing a lot of mismanaged assets too. Like talk to me about the expenses and what is the typical like expense ratio that you're accustomed to seeing, and are you seeing expenses that are exceeding that, or are you seeing properties right now that you're looking at that have expenses that are like way out of whack and should be a lot lower because they're being mismanaged?
Sure. Yeah, I actually was just underwriting a deal the other day where I didn't see that much upside in the income, but their expenses were through the roof. Like, our typical payroll costs is somewhere between 13 to 1,500 unit. This was over 2,000 unit. The utilities, just the electric bill, I noticed it was a smaller property. The electric bill was, over 150,000, over 170,000. But if you looked at it the last few months, it was only about 100,000. So I asked questions about that, and it turns out it was some mistake in the billing. So I don't know if it's been because it was mismanaged, but it's definitely something that I've been, on the lookout for, what we could do to lower expenses. Sometimes properties, utilities are higher water and sewer because they have older toilets. We'll put in low flow toilets. That's something that we like to do. Certain things that we definitely look at where even if, especially in today's market where there may not be as much upside of the income, where you're not going to be able to push rents as much because, you're kind of capped and the rent growth is definitely cool. And then in some place, negative rent growth. It's definitely something that we'll be on the lookout for, what we could do on new acquisitions and current deals, what we do to bring down expenses, what we do to negotiate better rates. What could we do to bring down, cut our expenses, because obviously that it can't, raise rents as much as maybe we could have, or if it doesn't make sense or people are not going to spend as much for a unit, we have to figure out a way to get creative and bring our expenses down for sure.
Have you noticed an uptick in the saturation levels for demand in the multifamily sector?
In what sense are you referring to?
In the sense that, like, have you noticed an uptick in like the overall amount of demand in multifamily? Meaning, like, are you seeing multifamily getting more competitive or less competitive?
So I would say now it depends on the market. certain markets, I think have become a little less competitive. The ones that were super hot before the rent growth started going down, certain markets like Austin, Phoenix, I think got a lot less competitive.
Mm-hmm.
Certain markets like Florida, Louisiana, Texas that have insurance costs are through the roof. I think those markets also got a bit less competitive in the sense where, I think deals in Dallas are still trading at like a 5 cap when most people are looking at things 6.5 caps. So I think certain markets have definitely cooled. But then there's other markets that are still very hot where people are running after, like Ohio, Indiana, certain Midwest markets, and things where people are running after where they can get, a decent in-place cap and maybe a little bit of a lower rent on average. So there's still some rent growth. I think there's definitely been an uptake, especially now where the treasuries are kind of all over the place, where rates are kind of fluctuating. Everybody's kind of hoping to grab it when it's on its way down, like kind of at that point, so that they can get a good deal and then refinance or sell it at a lower cap rate, which is obviously, huge opportunity now in today's market, and get a deal at the right price point and then sell it at the right place. Obviously you can do really well. But again, it's hard to know. I think a lot of people thought that the rates had already cooled off and they didn't. But I would say about 6 months ago, things were 6 to 9 months, but these were much quieter. There was a lot less competition. Brokers were coming back to us and saying, hey, what do you think this deal makes sense versus a year and a half, 2 years ago? It was, if you're not going to hit at least the asking price, don't even submit. So definitely definitely become a lot less competitive. And a friend of mine who's a broker actually had an interesting post on LinkedIn the other week, how he put a deal on the market and then and somebody was interested, but he never submitted an offer. And then he did, when he broadcasted it, that it sold, the guy reached out to him and said, hey, how come you didn't get back to me? He says, well, you're not going to submit an offer. Even if your offer is the 15th offer, but at least you're sitting at the table. So definitely in today's market, I feel that things are a lot less competitive, even though things are starting to heat up a bit, but it's definitely not the same market as we saw, prior to rates jacking up for sure.
Yeah, it's interesting. Well, we are coming up on time. So just a couple of last questions here for you. And actually you hit on one of the questions that you started to hit on it. And then I want you to finish that, which is, where do you see the future of, we'll just say the commercial sector in general with the current interest rate environment? What is your take on what's happening right now and what we could expect in like the next, say, 12 to 24 months?
So obviously I don't have a crystal ball.
Yeah.
But I could say what I feel and what I hope. Like what I said before, I hear a lot of people saying survive till 25. I think it's still going to be another 12 to 18 months before we're going to see some stability. But I think in the next 6 to 12 months, you can start seeing things peter out, where if you could get in at the right price point and the right interest rate, rates may go down and you didn't lock in the lowest rate, but you still got in at a point where it's not going to go up significantly or, fluctuate. I think if you can make sense and make deals work in the next 6 to 12 months, I think in 18 to 24 months, it'll end up being in a good spot. I really do feel and hope that way. Obviously, I don't know for sure. I know the 70s and 80s the rates went up to 18%. So I'm hopeful hoping that doesn't happen. And obviously that hasn't hit, the rates haven't been this high since, early 2000s. But now that we're starting to see the treasuries kind of go down, I think we're going to start seeing, deals come to market where, people maybe that don't have to sell, but maybe getting to a point that they're ready to sell. I'm hoping in the next 12 to 18 months brings a lot of opportunity.
Yeah, I would agree. I would definitely agree there. Well, Daniel, in traditional Gould Mine fashion, why don't you leave the audience with one final gold nugget?
Right. So there's something that I do as a religious Jew. I practice the Sabbath. And with everything happening in the world, I'm not to get political. There's been people recently that have been embracing that even more. And what I do is every Friday evening to Saturday evening for 25 hours, I turn off my phone. I spend time with my family and with my community. And that is definitely my gold nugget, that it's something that lets me reset and refresh. And if I didn't have that, I'd be working 24/7. So that's something that I feel is something that everybody could take on their own level, to turn off their phone, disconnect, reconnect for a few hours, spend time with their family, spend time with their community, just, spend time with nature, whatever it is that they feel that they need to disconnect. And that definitely helps keep me level and keep me going.
Awesome, Daniel. Well, that's awesome. And yes, I've heard you say that a couple times on a few different shows. And I think that's great. I know that's a hard thing to do in today's world, but that's that's why it's worth it, right? Like if it were easy, everyone would do it. So, hey, Daniel, thanks so much for stopping by. If people want to get in touch with you or they want to follow you, what's the best platform for them to connect with you?
LinkedIn, definitely. They could connect with me.
Awesome. And we'll have your LinkedIn profile linked in the description box down below. Daniel, thanks so much for stopping by.
Perfect. Thank you.
All right.